Welcome back to the afternoon session of our September 18th, 2025 Investor Advisory Committee meeting. Andrew, do we need to note if any IAC members have joined or departed as we're returning to the public session?
Yes, thank you, Brian. So Sergio Rodrigo is still online, as well as Christine Lazaro. It does not look like Alvin Velasquez is online, and I will note that Gina Gale joined us in person during the morning session.
Thank you so much, Andrew. Our afternoon session begins with part two of our panel, Reconsidering the Eligibility Criteria and Regulatory Treatment of Foreign Private Issuers. It's moderated by George Georgiev, followed by a discussion of potential committee recommendations later this afternoon, beginning at approximately 3:30. George?
Thank you, Brian, and welcome back, everyone. So we're going to proceed with part two of our discussion on the regulatory treatment of foreign private issuers, following on, in part, on the SEC's concepts release on the same topic from June of this year. We got a lot of very helpful information this morning, and we have two distinguished panelists with us today for a more technical discussion about some of the specific problems with the current FPI regime and then some of the solutions that may be available to the Commission. We have Jeff Mahoney, who is the General Counsel of the Council of Institutional Investors, representing the institutional investor perspective. Thank you for being here, Jeff. And we also have Paul Dudek, who is no stranger to this building. He used to be the chief of the SEC's Office of International Corporate Finance and very well known to capital markets lawyers working in this space. He is currently a partner at Latham & Watkins, and he also is one of the primary drafters of a comment letter that addressed some of these issues and the potential solutions. And I should also mention, of course, that Jeff wrote a comment letter on behalf of CII and also was involved in a very helpful report on the VIE structure. So a lot of knowledge on the panel, and without further ado, I will turn it over to Jeff to get us started.
Good afternoon. I want to thank you, Professor Georgiev, and Investor Advisory Committee Chair Brian Shore, other members of the committee for the opportunity to speak with you again today. I'm appearing here today on behalf of the Council of Institutional Investors. CI is a nonprofit, a nonpartisan association with a core membership that includes U.S. asset owners with assets under management of approximately $5 trillion. Those member funds include major long-term share owners with the duty to protect the retirement savings of millions of workers and their families, including public pension funds with more than 15 million participants. These are true and real Main Street investors through their pension funds. Our associate members include non-U.S. asset owners, approximately $5 trillion in assets under management, and a range of asset managers with more than $74 trillion in assets under management. As Commissioner Hester Peirce noted in her June 4th statement in response to the concept release, she said that one of the animating principles of the Commission's past rulemakings related to foreign private issuer eligibility has been the notion that various accommodations and relief from domestic rules are appropriate because foreign companies are subject to meaningful regulation and disclosure obligations in their home jurisdiction. I think many would agree that that principle is fundamentally sound, and 20 years ago, when the SEC last addressed foreign private issuers, that principle fit neatly with the composition of 20F filers that at the time were predominantly incorporated and headquartered in Canada and the United Kingdom. But you fast forward to the present day, and it appears that the principle that governed the SEC's thinking about foreign private issuers 20 years ago is now routinely contravened by many of today's foreign companies. More specifically, the Cayman Islands and China are now the preferred location of incorporation and headquarters, respectively, for foreign private issuers. Although China is developing a securities regulatory regime, I think few would argue that it provides meaningful investor protections when compared, particularly when compared to the United States. And many experts view China as possessing an immature disclosure system that leaves investors, and I'll just, as described in the September 8th Better Markets comment letter, it leaves investors with, quote, a severe asymmetry information problem. And as NASDAQ recently observed in connection with a proposed change to their listing standards, they said the unique risks that Chinese companies present to U.S. investors due to barriers on access to information and limitations on the ability of U.S. regulators to conduct investigations or bring or enforce actions against the company and non-U.S. persons, NASDAQ says that creates concerns about the accuracy of disclosures, accountability, and access to information. Similarly, many corporate law experts agree that investors in issuers incorporated in the Cayman Islands have far less meaningful protections than investors and issuers domiciled in the United States. The Cayman Islands has erected a range of procedural barriers as part of their corporate law that precludes shareholders from holding directors and officers accountable, even when those directors and officers actively participate in corporate lawbreaking. As SEC Chair Paul Atkins indicated in his September 10th speech in Paris, foreign private issuers headquartered in China or incorporated in the Cayman Islands subject U.S. investors to regulatory disclosure and governance frameworks that implicate shareholder interests. And as a footnote to that comment, I would just highlight that the negative implications for shareholder interest derived from those frameworks are further exacerbated by the complex and opaque variable interest entity structures adopted by many foreign private issuers headquartered in China and incorporated in the Cayman Islands. The negative implications to investors of those variable interest entity structures are discussed in detail in CI staff's recently issued report entitled Behind the Veil, Risks of Chinese Companies in the VIE Structure, freely available from CI's website, www.cii.org. Just had to throw it in that commercial. A relevant question raised by the SEC's concept release is how the Commission might change the foreign private issuer regime to reestablish that animating principle that Commissioner Peirce talked about, that foreign private issuer eligibility is appropriate only for those companies that are subject to meaningful regulation and disclosure obligations in their home country. You know, thinking about possible solutions to that question, and I acknowledge I didn't include a specific solution in the CII letter, I want to commend my co-panelist, Paul Dudak, for co-authoring one potential solution that I believe is worthy of the Commission's further consideration. That potential solution is described in pages 6 through 8 of the September 8th comment letter submitted by the Federal Regulation of Securities Committee of the Business Law Section of the American Bar Association. As Paul can describe in more detail, I'll call it the ABA Paul proposed alternative. Includes three key features. And again, he can discuss them in more detail, but one, retains the current definition of foreign private issuer, creates a new definition that addresses a subset of foreign private issuers that are not subject to meaningful regulation and disclosure obligations in their home country. And it does that by capturing in the new definition those foreign private issuers that have been identified by the Commission staff as having their equity securities traded almost exclusively in the U.S. capital markets. And when you look at the SEC staff data contained in the concept release on that subset of foreign issuers, that would include more than 80% of the foreign private issuers with headquarters in China and more than 80% of the foreign private issuers incorporated in the Cayman Islands. So under my ABA-Paul proposed solution, those foreign private issuers that fall under this new definition would be required to provide 3 additional regulatory disclosures that I believe, at least with some minor improvements, many investors would find decision useful. First, the proposed additional disclosures would require that subset of foreign private issuers to file financial statements on a new Form 7K, provided in a manner comparable to the information contained in Form 10Qs by domestic issuers, including a requirement that those foreign private issuers use the SEC's definition of materiality rather than some local definition. Second, the subset of foreign private issuers required to comply with the insider trading provisions of Section 16A of the 34 Act, including the filing of Form 4s reporting changes in ownership. I think Professor Taylor talked about his research on that topic in the morning. Finally, the subset of foreign private issuers would be required to provide additional disclosures comparable to those provided by domestic issuers in response to items 1 through 6 of Form 8K, including the requirement that those filings be submitted within the same time period required by domestic issuers, which is generally, as you know, 4 days after the triggering event. So the ABA-Paul proposed alternative approach appears to me to have a number of potential advantages over some of the other approaches that I've seen offered in the comment letters. And in the interest of time, and because I have the expert sitting next to me, I'm going to leave it to Paul to discuss those advantages. And that concludes my prepared remarks. And I want to again thank you, Professor and Chair Shore, and other members of the committee for inviting me to come back to the panel. And I look forward to responding to any questions. Thank you.
Thanks so much for that, Jeff, and we'll return to you as part of the Q&A. Now I'll turn it over to Paul Dudek.
Thank you, Professor Georgiev and Chair Shore, for the invitation to participate on this panel. The work of the Investor Advisory Committee is a key input to the SEC as it considers its regulatory priorities and initiatives. And I am glad to be able to contribute to your efforts. Thank you to the other members of the committee, and welcome to the new members announced yesterday and here today. As noted, I am a partner at the law firm of Latham & Watkins. I joined their DC office in 2016 after a 26-year career here at the SEC in the Office of International Corporate Finance in the Division of Corporation Finance, 23 years as chief of that office. And as noted, that office is the one principally responsible for overseeing the SEC's rules that deal with foreign private issuers. And yes, I was part of the drafting group that wrote the comment letter submitted by the Federal Regulation of Securities Committee of the Business Law section of the American Bar Association that Jeff mentioned. That letter, whatever we call it, the ABA letter, there's of course a lawyer-like paragraph in there that says it doesn't represent the views of the ABA or the Business Law section or anyway. It is informative to the SEC's process in a comment letter that was written by. That letter was really a group effort, me along with a number of other lawyers, practicing lawyers named in the letter, who participate in the work of the International Securities Matters Subcommittee of the Federal Regulation Securities Committee of the Business Law section. And I'm not here on behalf of the American Bar Association or any ABA subgroup or my firm, but I do have extensive experience relating to foreign private issuers based upon my time at the SEC, and since then representing a large number of foreign companies, both those that are listed in the United States and those that are not listed, some thinking about it and some, pretty sure they're not going to come, and also investment banks that are involved in the securities offerings of foreign companies. And the Commission is to be commended for looking into the appropriate regulatory treatment of foreign private issuers, and this committee likewise commended for focusing on this question. As has been noted, the SEC's approach to foreign private issuers dates back literally decades, and markets have changed dramatically, since the first foreign issuer accommodations were adopted by the SEC in 1935, much less over the past several years. And it's certainly a good practice for a regulator to periodically step back and assess whether its regulations are appropriately tailored to the changes that have occurred over time. And this is especially true with capital markets regulation, which greatly impacts the finances of the investing public. The concept release provides an in-depth analysis to the changes in the population of foreign companies that are registered with the SEC. And really kudos to the Division of Economic and Risk Analysis here at the SEC. There's just tables and tables and charts and really information that you can really sink your teeth into if you're interested in this data and sort of understanding changes over time. Having undertaken this analysis, the key question for the Commission and for this committee is whether the SEC should consider any changes to its approach to foreign private issuers. And many of the comment letters that have been submitted on the release argue that foreign companies may be dissuaded from a U.S. listing if certain accommodations that they currently enjoy are cut back. And certainly the ABA letter discusses practitioners' experience on the impact of the Sarbanes-Oxley requirements that came into place in the early 2000s. So a downturn in registrations by foreign companies with the SEC. And I have to say, over 20 years on, Sarbanes-Oxley continues to be top of mind for foreign companies considering a U.S. listing. It is a frequent question for IPO candidates that I get. When do the Sarbanes-Oxley requirements kick in when I list on the New York Stock Exchange, NYSE American, NASDAQ stock market? A U.S. listing by a foreign company on its own, even with the current accommodations, have significant benefits that have to investors. And these are benefits that are under the securities laws in addition to economic benefits, such as having a diversified portfolio, and practical benefits such as ease of access to purchase foreign securities on a U.S. stock exchange in the same way that U.S. securities can be purchased. One sort of legal benefit is, first, under the Supreme Court's Morrison decision, the SEC's basic bedrock anti-fraud provisions, Section 10b and Rule 10b-5, apply to transactions that take place on a U.S. stock exchange, and not necessarily to transactions that take place on a foreign stock exchange. This is a powerful protection that is lost when foreign companies do not list in the United States and U.S. investors need to purchase securities abroad. Second, the rules of the U.S. stock exchanges, which have all been vetted through the SEC, are designed to ensure fairness and efficiency in the trading process, and U.S. regulated entities are involved in every facet of securities transactions. That would not be the case when foreign shares are purchased or sold outside the United States. And lastly, when an FPI chooses to list in the United States, it will implement a financial reporting infrastructure that on its own provides significant benefits, such as the Sarbanes-Oxley mandated internal controls and an audit committee, a PCAOB registered audit firm. The ABA letter outlines those areas, and they've been discussed at this committee as well. The ABA letter advocates in favor of maintaining the current SEC regime relating to foreign private issuers, both in terms of the definition of the term foreign private issuer and the various accommodations that are afforded to foreign private issuers. But the letter understands, and this drafting group understood, that the SEC may determine to propose changes. And to that extent, the letter makes suggestions in light of the alternative regulatory approaches that were outlined in the release. The principal suggestion is twofold. First, maintain the current foreign private issuer definition for companies that are not registered with the SEC, so that well understood and apparently well working rules such as Rule 12G32B and Regulation S and Rule 144A as applied to unregistered foreign companies continue as they have in the past. Most of the SEC's concept release focuses on companies that file reports with the SEC, and the need to change the definition of foreign private issuer for foreign unregistered companies is much less clear. So second, the ABA letter suggests to have a scheme that differentiates sole U.S.-listed foreign companies, what the release refers to as U.S.-exclusive FPIs, from others. The letter suggests a new category of restricted foreign private issuer, which would be an SEC-registered foreign company that has 99% or more of its worldwide trading volume taking place in the United States. The letter recommends that this category of restricted foreign private issuer would be subject to special filing requirements, such as a Form 7K that would include semi-annual financial statements. Such companies would also be subject to disclosure requirements under Section 16A of the Exchange Act discussed this morning, although not the short swing profit recapture provisions of Section 16B. These companies would also be required to file Form 7K reports in a manner that tracks items 1 through 6 of Form 8K filed by U.S. companies. These are material transactions, change of auditors, changes among directors and officers, and other key matters that are picked up in these items of Form 6K. The release discusses alternatives, such as the Commission or its staff making assessments of foreign stock exchanges or foreign regulatory regimes. The ABA letter notes the difficulties inherent in making determinations with respect to other countries' disclosure requirements and governance regimes. This was mentioned in the prior panel as well, noting that there are hundreds of stock exchanges around the world and new trading venues being created all the time, it seems. We see that in the United States, new stock exchanges sort of coming up, and that trend exists outside the United States. And also these assessments not only would have to look at the black letter rules of a particular jurisdiction, but also how they are applied, which would be a significant process. You could have a jurisdiction adopt Regulation SK and SX wholesale, but it's how those disclosure requirements are applied to their companies that would make a difference, and that assessment would be difficult, we think. Two other matters to note for this committee. The ABA letter suggests that eligibility to use IFRS should not be changed, especially for companies that are currently eligible to use IFRS. IFRS is widely accepted around the world and is a high set of quality accounting standards that the SEC has fully accepted, and I think that U.S. investors should be very familiar with by now. Foreign companies may choose IFRS over U.S. GAAP, simply because local audit firms and internal accounting staff, have become less knowledgeable about U.S. GAAP, and IFRS is also what local creditors may expect. And also, a company starting out wouldn't necessarily turn to U.S. GAAP if it's incorporated in, in doing business in outside the United States, in Europe, in the Middle East, in Australia. They would use local GAAP or IFRS more likely. And the fact that they would grow eventually and have to switch over to U.S. GAAP would be a significant change. The other matter the letter notes is a suggestion not to change the approach with respect to ADR's American depository receipts. Even for a foreign company whose sole listing is in the United States, ADRs may be appropriate because of local law requirements, more relating to where a company's share transfer records are located. ADRs mostly layer on top of ordinary share structure and really have no bearing with respect to FPI status. Those are my prepared remarks, and happy to answer questions from the committee.
Thank you very much, Paul. So before I open it up to the rest of the committee, I wanted to ask a couple of follow-up questions and amplify some of the points that you made. First, Jeff, it would be helpful to hear your reaction in particular on the IFRS regime and whether that is worth maintaining. And second, to the extent you've had any discussions with investors about FPIs in particular, it would be helpful to hear some of the feedback that you've gotten in terms of what they look for. Is it really something that they look at when they seek to diversify, or is it really under the radar and they haven't focused on the FPI regulatory regime? The reason, in part, why I'm asking this question is because I was surprised by the lack of, or the low volume of letters from investors in the comment file. And it seems to me that investors this regime is fairly esoteric, and they may not have taken the time to understand it, but query whether once they realize all the regulatory exemptions that FPIs enjoy, whether they would be as comfortable investing in FPIs. So I know that's a lot to chew on, but would love to get your thoughts on that.
Thanks for the question, Professor. On the second question, I think it probably depends on who you talk to. Within our membership, you might get some different answers depending on whether it's the CIO or if it's someone in corporate governance at a public pension fund, for example. I have not received any negative comments about our comment letter. We have a long-standing position about the importance of disclosures for good corporate governance and that they benefit the long-term investors in our capital markets. We were quite involved in connection with the Sarbanes-Oxley Act and supportive of the PCOB and supportive of the PCOB having to inspect registered auditors that were in China and elsewhere around the world. So we've always had support there as well. The first question, I was actually on an SEC, I was telling Paul, I was on an SEC panel when Christopher Cox was chair of the SEC, where they proposed eliminating the reconciliation requirement from, if you used IFRS as written, they proposed you wouldn't have to reconcile to US GAAP. I was one of only two panelists on the entire panel that raised concerns about that at the time, because back then, as opposed to now, there wasn't a lot of knowledge from U.S. investors about the differences between U.S. GAAP and international standards. And one way they learned about the differences was to look at the reconciliation required by the SEC. So when they proposed to get rid of that reconciliation, I opposed it largely for that reason. Paul points out correctly that many years have passed. I was a much younger man back then when I was on that panel, and so U.S. investors now know much more about international standards and how they differ from U.S. GAAP. So that concern I raised back when Chris Cox was chairman of the SEC is certainly not as significant a concern as it is now, given the time that has passed and the knowledge that U.S. investors have gained about international standards.
Excellent. Thank you very much for that. Paul, you mentioned as part of your initial remarks that you also represent or have conversations with investment banks and underwriters. And I was just curious, zooming out, about your views on the role of gatekeepers and underwriters as part of that subset within the entire FPI ecosystem, because for a foreign private issuer to come to the U.S. markets, they certainly need help from and the participation of an underwriter.
Yes, and they play a key role, the same role they play with respect to U.S. companies. I mean, the diligence that is done is identical. You wouldn't know, in terms of the questions that are asked, the time that's taken. There's sort of local resources brought to bear wherever a company is doing business. It's not necessarily a place of incorporation, but where are their sales? So the same sort of vetting of customers, of operations, everything that an investment bank would do. Because investment banks, clearly they take their obligations, very seriously. Not only because, there are sort of liabilities sort of under Section 11, but the reputational and many other factors sort of go into the role of investment banks in terms of the diligence that they do and making sure that a company is IPO ready. There's a lot that goes on in terms of what are controls in place. But from a business point of view, is this company growing right? Will it have a revenue stream? So there's commercial aspects to it, and then there's also organizational aspects to it in terms of is this company going to be reporting? Does it have controls in place? Does it have internal audit? Is it ready? Does it have an IR function? A private company doesn't, and so it will have to, how will it be presenting itself to investors? So that is everything that, investment banks and other advisors, sort of help foreign companies to the same extent that that is true for U.S. companies. Maybe a little more, getting companies up a learning curve in terms of the U.S. system, maybe a U.S. Entrepreneur, has heard about the SEC since, the first days of business school or when they were working in their garage, or as an entrepreneur in Europe or in Vietnam, may not have heard of the SEC or, what is the PCAOB and what does an audit firm do?
And so if we assume that underwriters spend a lot of time and resources and attention to the IPO process for foreign private issuers, when we get data such as the one presented by Professor Dan Taylor this morning of really failures in the performance of some of those IPOs, especially single-listed or U.S.-exclusive IPOs, should we assume that something broke down in that process? Or more broadly, is there anything that the Commission or this committee should be looking at with respect to the regulation of those gatekeepers? Could it be the fact that the gatekeepers have been asleep at the job in some of these cases versus the SEC's regulatory regime for foreign private issuers being somewhat inadequate? And I suspect that there is actually probably some geographic variation between the availability of underwriters and the role of underwriters, just the local competency in different parts of the world.
Yeah, and there's certainly a range of investment banks and underwriters sort of out there, and which is fine. This is the United States. Everyone can, sort of hang out their shingle and make a business. I know, certainly among our clients, which are, very large, they take their responsibilities very, very seriously. Don't know with respect to, an IPO or a company that might be viewed as a failure, whether the right processes sort of weren't in place, with respect to a particular bank in terms of helping a company, sort of, yes, be public in the United States, because that's obviously a large responsibility for the issuer and banks can be helpful in that process.
Got it. One of the things that emerged this morning was that additional data would be helpful. Obviously, the concept release contains a lot of data, but some of the panelists this morning also indicated other potential things that we should look at, that the Commission should look at, things that perhaps academics should try to find out. And so in what areas would you say that additional fact-finding may be needed or warranted, to the extent you have thoughts on that? And it would be great to hear, Paul, your view and also Jeff's view.
Yeah, one area, and I heard a little bit about this, I think from John from Cromwell, in terms of what is it that, what kinds of information are foreign companies sort of filing on Form 6K, or is, might be available on their website. You sort of see, there's a question about sort of periodic reports, and there's now a larger question about quarterly reporting in the United States, but we'll put that aside. Let's just say, in terms of what is the cadence of financial statement or financial information disclosure by foreign companies that are listed in the United States. And it requires sort of drilling down into the Form 6Ks in terms of, okay, is this an earnings release? Are they summary financial statements that are coming out on Q1 or Q2 or Q3? Is there an MD&A that is available that sort of matches what you would find on a Form 10Q? So that is information, because although, it's, a lot has been discussed in terms of foreign companies don't have to file quarterly reports. You also hear, but as a general practice, many foreign companies sort of are producing quarterly financial statements to some extent to investors, and sort of that helps determine as to whether there is a regulatory issue that needs to be addressed. Because if the companies are sort of voluntarily providing this, then there wouldn't seem to be a need for a regulatory response.
I just agree with Paul again that I was impressed with the volume of data that was in the concept release. And with respect to the three disclosures in the proposed alternative ABA-Paul approach, I think there's a significant amount of evidence, including empirical evidence, that would support those three items as being additional disclosures by that subset of foreign private issuers.
Excellent. I would like to turn it over to my colleagues on the committee, but while they're gathering their thoughts, I just want to remind those watching online or here in the audience that the Investor Advisory Committee does have a comment file. So to the extent there are any reactions or amplifications or additional evidence that commenters want to submit, we will look at those comments that you send us. Paul.
Yeah, thank you, George, and thank you, Jeff and Paul, for being here. Really appreciate your comments. I agree with Jeff that the ABA-Paul letter is worthy of careful consideration by the committee and indeed the Commission with some novel approaches to how to ring-fence the problem, if you will, or address the problem. I guess my question, Paul, is, we heard earlier this morning that Professor Taylor talked about applying Regulation FD to foreign private issuers, and I just wanted to get both of your thoughts on that, and then whether or not you would limit that to just the restricted foreign private issuers as opposed to applying to all FPIs.
Yeah, I don't think that's covered in the ABA letter. Personally, it was sort of something, so leave that for the Commission to sort of think about. Regulated foreign private issuers do have, are not required to follow Regulation FD. Nonetheless, I think just, Regulation FD has a anti-fraud, sort of 10b-5 sort of aspect to it. And I think you will find companies, largely comply, or at least foreign companies, it is a very good practice to sort of, look at Regulation FD and to follow that, and to follow that regulation and to not have selective disclosure. That was the great evil that Regulation FD was sort of put in place that, Arthur Levitt and Harvey Goldschmidt, sort of championed, and that was, and it has worked well. I don't think we have seen, abuses of that in the foreign private issuer area.
I did not discuss Reg FD in my comment letter. CII does not have a membership-approved policy related to Reg FD. I'm trying to think of my 19 years. Have I ever written letters about Reg FD on CII letterhead? And I may have, but it's never been a significant area of comment for CII, so I apologize for that.
Colleen?
So thank you both so much for coming out here today. And I think this is probably a comment or a question for Jeff, but Paul, if you have thoughts too, I would love to hear. So I'm curious, Jeff, if you have a sense for your members who are investing in FPIs, do you have a sense of how the diligence process would differ, or does it differ for an FPI versus a non-FPI? And also kind of ongoing conversations with those companies. Do you have a sense of what that looks like?
No, I don't, unfortunately. I think many of our members have significant allocations to foreign companies, including FPIs for sure. I think, as I mentioned earlier, I think depending on who you talk to at a public pension fund, you may get slightly different answers. I think, some of the chief investment officers, they want an investable universe that includes everything. On the other hand, they are supportive of our approach, which historically has been similar to Commissioner Peirce's approach, that you ought to have, if you're going to have the ability to have fewer disclosures, fewer regulations, there ought to be something in your home country that gives us some protections that's at least somewhat comparable to what we have in the U.S. That's where our members have always been. But depending on who you talk to at a fund, you might get slightly different answers on how important that principle is. But that's our longstanding principle.
Yeah, they don't let lawyers go to like investment meetings and test the waters meetings and roadshows and hear investor questions. So yeah, don't have a sense. I do get that it is a process. I mean, just like there are one-on-ones or sort of small group meetings between management and prospective investors. That happens on the U.S. side and it happens on the foreign side, and investors, are looking for information. And if they feel they're not going to get, they're not getting the right answer, or something doesn't match what they see in a preliminary prospectus, so they won't buy. And then if they're enthusiastic and they sort of understand management, sort of where it's going, then they be more willing to invest.
Yeah, it's common sense, but I think if we change the rules so that no Chinese company could be an FPI, I think many of our public fund members, particularly chief investment officers, would not be supportive of that. But an approach like Paul's, which gives us better disclosures about those companies, I think is something that would get broad support among institutional investors.
All right, Andrew and then Brian.
Do either of you have any sort of clarity or some thoughts on, with the variable, the VIE structures? Obviously, for each jurisdiction, there's a pretty clear-cut set of, in cases of insolvency, for example, right? There are pretty clear-cut cases of how that gets resolved, and everyone has a different claim, obviously, based on their seniority. But, have we seen any sort of, good, example of kind of what that claim looks like if a VIE were to be in any sort of default or insolvency? Because I think the examples that are always raised is, you're not investing in the company itself, you're investing in the, right? So Alibaba, it's Alibaba Cayman Islands, for example, right? So do you have any sort of sense as to what that that resolution might actually look like in terms of either the actual claim on an asset or just how that gets resolved?
So I did a call for CI members on related to that topic a number of years ago, and there was a law firm in town who brought in action related to poor disclosures at a VIE listed here in the U.S., and he actually won, and he was able to get recovery from China. Part of it may have been because I think part of it might have been because the Chinese wanted to avoid the bad publicity that was going to happen if they didn't respond to the judgment. So there is a possibility that you can get recovery from the Chinese company, and there's at least one example when they've been successful in doing so. I don't know if I'm not aware of another example where they actually were successful, but there is one precedent at least where the Chinese company decided to provide the judgment, but again, it might have been more kind of a PR issue to protect kind of the reputation of the company.
Yeah, and I'm not aware. Didn't even know about that. I guess I would say, but it's sort of true whether you have, when you have a holding company, and whether it's a wholly owned subsidiary or through a contractual arrangement, sort of reaching down to assets, especially in another jurisdiction, is always a challenge. Whether it's a VIE structure or a wholly owned subsidiary, there can be a challenge in terms of finding assets for what is just a holding company.
Yeah, the bottom line is good luck.
Brian?
Paul, I'm curious, in drafting the letter, did you and the other draftspersons involved think about whether, if there is any additional regulation going forward, whether it should be from the SEC or, on the other hand, from the stock exchanges, from the SROs?
No, that wasn't. This was an SEC concept release, and I think we saw this, or I think the other committee members, not speaking for them, but that didn't come up. Certainly, in thinking about this sort of personally, yes, is this sort of something that could be addressed, at the stock exchange level, to some extent. I heard sort of the other panels as well, the stock exchanges are really just businesses, and so they're always looking for listings, but they are regulated entities, and I know that they get inspected, and those inspections are serious because they're by the SEC, and you sort of see penalties, and so that is a possible avenue, because they're self-regulatory organizations.
Right, and there are certain requirements that are listing requirements that go through the SEC, rulemaking process with respect to the exchanges.
Yes.
Yeah.
Yes, and you see, to a large extent, the stock exchanges in terms of governance matters do defer to sort of home country matters, and maybe that's sort of something that can be looked at. The main thing is that the audit committee has to be sort of Sarbanes-Oxley sort of compliant, and both New York Stock Exchange and NASDAQ. And I think the NYSE American have requirements that companies have to have a semi-annual report as well.
Right.
I would just say I've written a lot of comment letters to the stock exchanges as well as to the SEC. I've been involved with the NASDAQ and various committees for 16 years. I wouldn't object to the stock exchanges addressing these issues. I do like the idea that if the SEC pursues it, we're going to have the economic analysis. We're going to get a lot more feedback and comment. When I write letters related to listing standards at NASDAQ, New York Stock Exchange, sometimes I'm the only one writing the comment letter, or I'm a very small group. Obviously, if it's an SEC proposal, we're going to get a lot more robust feedback, and they have their economic analysis and process they have to go through, which I think often leads to good results.
Let me ask the reverse of the question that we've been asking all day long, which is what are the problems with the regime and how can we improve the regime by closing some of the regulatory loopholes perhaps, or addressing some of the blind spots that are out there. What about things that are currently in the regime, the FPI regime, that maybe are extraneous or that the Commission should consider revisiting that will improve the U.S. exchanges and the U.S. capital markets, their attractiveness and availability for FPIs, without at the same time having any downsides in terms of investor protection? That's mostly for Paul, but Jeff, if you have any thoughts, that'll be helpful.
Yeah, sort of think about that. It sort of takes me back, when Sarbanes-Oxley was put in place, as well as Dodd-Frank, but when Sarbanes, sort of significant new requirements, and there was a question, how do these apply, or how will they apply to foreign companies? Will they give the CEO and CFO certifications? What about audit committees? What about blackout trading periods? I mean, everything that Sarbanes-Oxley has, insider loans. And it was determined, Congress passed this, and it is the law of the land. And they said all issuers, it was all issuers. And I remember sort of, talking to, even at the SEC, foreign companies would say, although there was some grumbling, sort of in the long term, they thought that Sarbanes-Oxley made them better companies, because they sort of brought them, the internal controls, the disclosure controls, having a robust audit committee, actually improved companies from an operational, commercial point of view. And large companies, global companies, would find it difficult sometimes to sort of rein in their sort of, many offices and sort of using Sarbanes-Oxley as an excuse. So that was, and I think, as it's turned out, I think Sarbanes-Oxley, it's written large, has improved the U.S. market, dramatically. Are there changes, that should be sort of cut back? I'll think about that. I don't know, and maybe send in a comment letter to the committee, sort of come to mind.
I have nothing to add other than your comment on SOX. I mean, a number of major markets around the world actually adopted big chunks of Sarbanes-Oxley, so it seems to have been quite successful, or at least viewed that way at many major markets around the country, including, a number of countries have adopted something very similar to the Public Company Accounting Oversight Board.
Yes, that's a great example.
So at least in that case, it's been very successful, both, I think, domestically and globally.
Perfect. Well, this was very informative, very illuminating. I think this gives us a lot of evidence and a lot of evidence of things that are happening out there and that we should take into account, and also suggestions for things that we should continue to look at as part of our deliberations if we proceed with a recommendation. So thank you, Paul, and thank you, Jeff, for joining us today. Speaking of recommendations, after a couple of minutes break, we'll proceed to the next item on our agenda.
George, thank you. Paul, Jeff, thank you as well. That wraps up our second part of the FPI panel. We will reconvene again in 5 minutes. Thank you. Welcome back to our afternoon session. Next, we're going to discuss potential recommendations of the Investor as Owner and Market Structure Subcommittees regarding retail investor access to private market assets. The committee will consider and vote on recommendations pertaining to the regulatory framework governing retail investors' access to private market assets. IAC Vice Chair Paul Roy and Investor as Owner Subcommittee Chair Andrea Sight will lead that discussion. Andrea, Paul.
Thank you, Mr. Chairman. Andrea and I are pleased to outline the recommendations of the Investor as Owner and Market Structure Subcommittees of the SEC's IAC regarding retail investor access to private market assets. Since the 1990s, a greater number of American companies have remained private or been taken private, causing the number of public companies to drop from 8,000 in 1996 to only 3,700 in 2024. Accordingly, the private markets have grown at a rapid pace in recent years, with U.S. private funds currently managing over $30 trillion in assets, and U.S. private companies directly raised $623 billion in 2024. Given the size of the private markets and the investment opportunities they contain, the question of facilitating retail investor access has been raised with increased frequency by investors, market participants, legislators, and policymakers. There's widespread agreement that changing the status quo entails a host of difficult policy questions. According to the IAC, has held multiple panels and issued multiple recommendations pertaining to these matters in line with the statutory mission to advise the SEC on regulatory priorities, initiatives to protect investors, and initiatives to promote investor confidence and the integrity of the securities marketplace. Our committee finds that the rise of private markets necessitates a recalibration of the existing regulatory framework, which was designed for a world in which the public markets encompass the vast majority of all investment opportunities. Importantly, the Commission believes that this recalibration should not undermine any of the three pillars of the SEC's mission: protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. In our view, the optimal way for retail investors to access private market assets is through registered funds, which allow retail investors to invest in broadly diversified funds that contain private market assets, often alongside public market assets. Importantly, the registered funds framework embodies the significant protections of the Investment Company Act of 1940. The committee, however, recommends enhanced investor protections and disclosures, as well as changes to staff interpretations and our rules under the Investment Company Act to allow registered funds to better facilitate investing in private market assets. The committee does not take a position on the desirability of expanding retail investor access to private market assets in direct ways, but if the Commission were to determine that such an expansion is warranted, the committee firmly believes that it should be accompanied by certain basic investor protection guardrails. I will outline our recommendations regarding targeted reforms in the registered fund regulation, and then turn to Andrea to outline our recommendations regarding direct access to private market assets, including our views on the accredited investor definition and Form D policy and procedures. Following Andrea's presentation, we will then open up for comments and questions by the committee members. Now, the way that most retail investors access private assets today is indirect, through an investment in a registered funds that includes at least some private assets. Registered funds include closed-end investment companies, interval funds, tender offer funds, exchange-traded funds, and mutual funds. There's over $35 trillion currently managed by registered funds. Interval and tender offer funds are specialized types of closed-end funds that generally do not list their shares, but provide periodic liquidity at net asset value, a feature that makes them attractive to investors who seek exposure to private market assets. These funds offer a practical and more transparent vehicle for expanding retail access to private assets than some of the main alternatives, including unregistered or exempt offerings, because registered funds were developed specifically for retail use and offer numerous protections that are not found in non-public offerings. These protections include commission review and inspections, extensive mandated disclosures, audited financials, professional fund management subject to fiduciary obligations, diversification, various levels of liquidity, oversight by independent fund directors, safekeeping of assets, as well as other protections of the Investment Company Act. Now, these benefits are safeguards for retail investors, important safeguards for retail investors given the opaque and complex and illiquid nature of private assets. Yet some registered funds are limited in how much they can allocate to private assets and must contend with other restrictions that discourage fund managers from including more private assets in their retail offerings. By revising these requirements, the Commission could expand retail access to the private markets through safer registered vehicles. While relaxing restrictions on registered funds investing in private markets may address some of the pent-up retail demand for those assets, like other strategies that seek to increase retail exposure to alternative investments, the changes do not come without risk. Fundraising from institutional investors has slowed significantly in the alternatives marketplace, and some of the largest institutional investors have been looking to sell their stakes for the first time in the secondary market. Existing institutional investors in a number of private funds have seen their distributions drop to historically low levels, leading some institutional investors to sell stakes in these funds into a secondary market. And some funds have attempted to sell some of these hard-to-sell assets into continuation funds, where assets from an existing fund are sold into a new fund managed by the same advisor. However, industry estimates show that 85% to 92% of institutional investors are opting to sell rather than move into continuation funds. Now, some market participants have suggested that an increase in retail participation in the private markets through registered funds could accelerate the growth of secondaries. In addition, some market observers are questioning whether and how the higher returns touted on the institutional side of the private market will translate over to the retail side, given the additional fees imposed on retail shares. And other market observers also question how registered retail funds will be able to navigate illiquidity challenges as private asset allocations increase. Now, since the IAC held its mainstreaming of alternative assets to retail investors panel in December of 2024, applications for a number of registered funds, such as exchange-traded funds and interval funds, have been filed with the Commission. These products offer retail investors opportunity to invest in alternative assets without being an accredited investor and with relatively low investment minimums. These developments further suggest that the Commission should consider additional safeguards given the potential adverse implications for retail investors who may have a significant percentage of their savings and retirement assets tied up in such products, but may need to access those funds due to unplanned or sudden life events. There's a difference between investors losing money due to an affirmative choice to take excessive risk and a loss due to a failure to understand the features and mechanics of funds invested in illiquid private market assets. It is essential, therefore, that registered funds investing in private market assets establish robust investor protections and disclosures from the outset, recognizing the diverse set of retail investors with varying levels of financial sophistication. We recommend that the Commission require funds to provide clarity and transparency on valuations. The IAC recommends that the Commission require funds to disclose additional information to retail investors to better understand how the values of portfolio assets that do not actively trade are determined, ensuring consistency across investment vehicles. The inherent lack of daily market prices for many private market assets also raises the need for the Commission to establish standards for an impartial party to determine the value of the underlying assets, especially as fees are charged to investors typically based on the value of assets, and disclose when fund sponsors reject or replace third-party appraisal. These standards become especially important as some ETFs have been offering retail investors daily liquidity to invest in private market assets, which in turn necessitates having to estimate the value of all the ETF's underlying assets daily, while those assets themselves trade infrequently. Among several business development companies, which are largely owned by retail investors and are primarily invested in private corporate credit loans, there have been notable valuation discrepancies across different BDCs holding stakes in the same loans. In some instances, fund advisors may engage in practices that immediately inflate the fund's NAV with no immediate increase in the value of the underlying assets. This occurs when an advisor purchases private assets in the secondaries markets at a discount and then immediately marks up the value in its own NAV, ignoring the competitive marketplace price the fund advisor itself just set. Given the growing use of private investments in fund portfolios, the Commission should emphasize the valuation responsibilities currently delegated to fund directors under Rule 285 under the Investment Company Act, with a view to providing greater investment protection. The IAC recommends the Commission require fund advisors report on a periodic basis to fund directors any rejections or replacements of a third-party valuation. Fund advisors should also disclose to investors the circumstances or conditions that would lead them to override third-party valuations. Such a process is especially important for retail-facing funds, as many investment decisions on the valuations presented to them provide little recourse in how investors assess the assumptions and inputs behind those valuations. Given that it's likely that a number of registered funds, including those offering daily liquidity, will own a number of illiquid assets that are held in institutional portfolios, we also recommend the Commission offer clarity as to what levels of discrepancies are acceptable in the normal course of business between the valuations used in publicly traded funds and those held in private portfolios managed by the same fund advisor, especially during volatile markets where such discrepancies between the funds could become noticeably greater. IAC recommends that the Commission's Examination Division make reviewing valuations of funds with significant investments in illiquid assets a focus area. The Commission's Examination Division should also examine performance figures in marketing materials, as retail investors will often make investment decisions based on those numbers. We next recommend that the Commission consider changes to staff interpretations and rules under the Investment Company Act to allow registered funds to better facilitate investing in private market assets without sacrificing the protections of the Investment Company Act. Chairman Atkins today talked about the change in staff policy that allows closed-end funds to invest more than 15% of their assets in privately offered funds without investors having to be accredited investors. We support that change as recommended by the chairman and adopted by the staff. We also recommend that the Commission provide flexibility for co-investments under Section 17D and Rule 17D1 under the Investment Company Act. This section and rule are designed to prevent overreaching in connection with joint transactions involving a fund and its affiliated persons. Now, we note that the SEC has issued multiple exemptive orders in this area, and what we're calling for is a codification of those types of exemptions and rulemaking so that funds don't have to come in and apply for individual exemptive orders. We also believe the Commission should provide greater repurchase opportunities for investors. Rule 23C3 under the Investment Company Act provides for quarterly repurchases of securities by interval funds. And the Commission has granted exemptive orders permitting interval funds to conduct monthly repurchases, and we think that should be considered for adoption or amendment to Rule 23C3 to permit monthly repurchases. Open-end funds are permitted to offer two or more classes of shares representing interest in the same portfolio. The SEC routinely grants orders to closed-end funds to offer multiple classes of shares. Again, this is another area where the Commission could codify this relief into a rulemaking. Open-end funds, Commissioner Crenshaw talked about open-end funds and whether or not they should be organized as series companies. A series company is a mechanism whereby you can have a single set of organizational governing documents, and you have series that represent a separate portfolio of with different objectives and risks. Now, I just want to point out that with the series fund, there still is Commission review of those filings, as opposed to just a standalone registration. When you file a series fund application or for approval, there is an opportunity for the staff to review and comment, and those comments to get reflected in an effective filing. We urge the Commission to enhance and make liquidity disclosures more prominent. The IAC recommends the Commission provide investors with a clear understanding of the major differences of retail funds invested in alternative assets, where they may be subject to longer redemption timelines and lockups. Now, such considerations are especially important since retail investors, again, may need to redeem money to meet both normal and emergency circumstances and do not necessarily have access to inexpensive alternative financing as institutional investors. Risk disclosures for retail investors should be simplified so they can understand the basic features of these funds in a clear and concise manner. The most important features of the fund invested in alternative assets should be clearly and succinctly presented. We encourage layered disclosure formats, such as summary dashboards or visual risk indicators, to make key risks more digestible, as well as require standardized language across fund documents to reduce confusion and improve comparability. The Commission should also strongly consider additional investor protections for retail-focused funds invested in alternative assets. Specifically, the committee recommends that the Commission work with FINRA and state securities regulators to monitor broker-dealer and investment advisors for compliance with Regulation Best Interest and obligations under the Investment Advisors Act of 1940 when brokers and advisors offer and sell funds and alternative assets to their clients. Indeed, FINRA recently fined and suspended a broker for violation of its rules when it determined that he put 3 clients with low or moderate investment risk profiles into illiquid alternative investments, which composed between 51% and 91% of the customer's net worth, exceeding his firm's concentration guidelines. The financial incentive conflicts arising from sales compensation, service fees, and revenue sharing arrangements that are common features of alternative products need to be properly disclosed and mitigated. Additionally, advisors should not engage in deceptive advertising of funds primarily invested in illiquid assets and market them as liquid or less risky than they are in reality. The SEC's Division of Examinations has previously issued risk alerts due to private fund advisors failing to act consistently with disclosures and using misleading disclosures surrounding performance figures. They should also look for opportunities to provide these risk alerts in this space. Now, finally, given the importance and challenges and consequential impact of opening private market assets to retail investors, we also recommend that the Commission open a request for comment to obtain input on key issues, including other ways to expand retail investor access to private markets while maintaining an appropriate level of investor protection, additional methods investment managers can use to effectively facilitate private market investments to retail investors, impediments retail investors may have in safely accessing private market investments, approaches other jurisdictions have taken to facilitate retail investments in private markets, and the systemic risk of the growth in the private markets. We hope these recommendations will serve as food for thought and useful input to the Commission. I now turn to Andrea to outline our recommendations regarding direct retail access to private market assets.
Thanks, Paul. I'm going to outline rather than read through Part 3 of the subcommittee's recommendation, which discusses various approaches and guardrails that the SEC should consider if it chooses or if it is directed by Congress to directly expand retail investor access to the private markets. As Paul explained at the outset, but it bears repeating, the subcommittees do not take a position in favor of or against expansion of retail access to the private market. On that specific question, consider the subcommittee's Switzerland. That said, the subcommittees understand that the SEC may be directed to expand retail access directly, or that the SEC itself may determine that expansion is warranted. Under those circumstances where retail access is expanded directly, the subcommittees recommend in Part 3 that the expansion be accompanied by investor protection guardrails. Before I discuss those guardrails, it might be helpful for me to offer a little IAC history on this topic because that history has informed and influenced the recommendations we present today. The IAC has held at least 9 panel discussions and issued 2 previous recommendations in this area. That body of work taught us 2 important lessons. First, there's no way to talk about or manage retail investor access without addressing the accredited investor definition. It determines who is and is not eligible to invest in the most popular form of private offering, Reg D offerings. The second thing we learned from all panelists over all those years is that no one likes the accredited investor definition. True story. No one's happy with it. But all joking aside, a consistent criticism of the definition is its reliance on the wealth test that either lets in too many vulnerable, unsophisticated investors or leaves out too many savvy, sophisticated investors, depending on who you ask. The IAC recognized that as early as 2012 and recommended then that the SEC move away from the wealth test and shift towards sophistication criteria. The IAC alternatively suggested, that the SEC consider limiting the share of an investor's total assets that can be invested in private offerings. The SEC did act on the first part of that 2012 recommendation by adding a passing score and some securities licensing exams to its list of qualifying credentials in 2020. There have been some studies conducted since, but no material revisions. And with that background in place, I will move to guardrail number 1. So guardrail number 1, the subcommittees would like to see the SEC emphasize investor sophistication rather than income or wealth as part of any potential expansion of direct access. With this guardrail, the subcommittees essentially repeat the recommendation of the inaugural IAC and recommend that access be anchored in investor sophistication, not investor wealth. Rule 501A10 of Regulation D gives the SEC the power to expand access today by publishing a list of credentials or designations that it believes demonstrate financial sophistication. The SEC relied on this authority in 2020 to qualify investors who passed the Series 7, 63, and 82 exams. The IAC reviewed private market access proposals to see what other credentials have been suggested, and we came up with a list of credentials that could be appropriate, subject to feedback elicited during SEC notice and public comment, of course. Those credentials include Chartered Financial Analyst, Certified Financial Planners, Certified Public Accountants, Chartered Financial Consultants, Personal Financial Specialist, Certified Investment Management Analyst, and Certified Private Wealth Advisors. We selected these credentials because they have rigorous competency examinations, minimum education and professional practice requirements, and continuing education requirements. In addition to credentials, the subcommittees also consider proposals that the SEC develop an accredited investor test. If retail access is going to be expanded, the subcommittees would support the notion of an accredited investor test subject to 2 conditions. Condition 1, the test would need to adequately probe the examinee's ability to understand the unique features and risk of making private market investments. Condition 2, the test would need to be developed by the SEC in consultation with other federal and state regulators, as well as industry and investor stakeholders. Moving on now to guardrail number 2. With guardrail number 2, the subcommittees recommend that the SEC place prudential limits on the amount that can be invested by retail investors who do not meet sophistication or wealth criteria and index the existing income and wealth thresholds for inflation on a going-forward basis. As I already covered, one of the chief criticisms of the existing definition is the perception that it unfairly divides the U.S. population into segments that either get unlimited access to the private markets or none at all. The subcommittees agree that this all-or-nothing approach is flawed, but do not recommend the SEC respond by shifting from no access to full access for unsophisticated, non-accredited investors. If the SEC determines that expanded direct access for retail investors is warranted, the subcommittees propose that a prudential limit be imposed akin to the limits utilized in the Jobs Act exemptions. As described in further detail in the recommendation, the subcommittees propose a framework where access is capped for retail investors who do not meet a sophistication test or the income or wealth criteria. Those investors could directly invest the greater of A, on an annual basis, up to 10% of their last year's individual or joint spousal income, B, in the aggregate, up to 10% of individual or joint spousal net worth, exclusive of personal residence and automobiles, or C, in the aggregate, up to 10% of the value of the investor's securities investments. If pursued, the committees expect that the SEC would solicit comment on this approach. The subcommittees also considered inflationary adjustments to the wealth test and settled on what we viewed as the least disruptive option. That is, to index the thresholds on a going-forward basis. Looking ahead, indexing for inflation would help ensure that the thresholds retain their utility as an imperfect but still relevant proxy for an investor's ability to withstand loss. We also recommended as a special consideration that the SEC study whether to exclude retirement assets from the calculations used in the wealth test. There are few things that the SEC does that is more important or more honorable than its work helping Americans save for retirement. The subcommittees did not have enough information to conclude today whether that would be best accomplished by including or excluding retirement assets from the wealth test. But the subcommittees agree that it is an important issue, as did the SEC staff in its 2024 report on the accredited investor definition. So we hope the SEC studies it and reports out its findings to ensure that any change that the SEC makes to the accredited investor definition does not harm retirees. And now moving on to the guardrails related to Form D policy and practice. As with the accredited investor definition, I'll share a little history to frame the discussion. Ever since Congress enacted the federal securities laws in the 1930s, the basic rule underlying the regulatory scheme is that any offer or sale of securities must be registered with the SEC unless it qualifies for a recognized exemption. The U.S. Supreme Court in SEC versus Ralston Purina established the criteria for claiming an exemption from registration under Section 4A2 and allowed the exemption where the persons participating in the offering did not need the protections provided by registration because they, quote, have access to the kind of information which registration would disclose, end quote. A subsequent Fifth Circuit decision elaborated that if investors did not possess the information requisite for a registration statement, they could bring their sophisticated knowledge of business affairs to bear in deciding whether to invest, meaning that an information deficient offering could not be exempt. In 1982, the SEC adopted Regulation D to allow issuers to offer and sell their securities offerings in limited private offerings without registration. Issuers relying on Reg D are required to file Form D with the SEC within 15 calendar days after the first sale of securities. Back then, the Reg D exemption had limited reach and scope, but it has grown significantly. While less than 2% of U.S. households would have had access to Reg D offerings in 1982, that percentage is close to or higher than 20% today. The private market itself has grown considerably as well, particularly since 2012 when Congress enacted the Jobs Act. There are useful statistics and a chart included in the recommendation to illustrate the significant growth and expanded reach of the private market during this time. Despite the exponential growth of private markets, the SEC has not taken steps to modernize the information requirements contained in Regulation D. This means more private offerings are being offered to more U.S. investors without the benefit of meaningful and consistent disclosure. It also means that the SEC does not, as market regulator, have much in the way of reliable information about a huge trillion-dollar piece of the investment market. The IAC has drawn attention to these issues in multiple panels, and in this recommendation, we summarize the challenges that investors face as a result of these market shifts. Those challenges include lack of fresh, accurate, and comparable information, information asymmetry, inability to perform adequate due diligence, and the inability to negotiate favorable terms. With those retail investor challenges in mind, I'll turn to guardrail number 3. Guardrail number 3, the subcommittees recommend that the SEC should enforce the already existing Form D filing requirement. This guardrail is not complicated. For this guardrail, the subcommittees simply recommend that the SEC enforce its own requirements. Issuers relying on Regulation D should complete all the requisite fields on Form D, file it within 15 calendar days of closing the first offering, and file amendments timely as required by rule. Enforcement could be achieved by conditioning the availability of Reg D exemptions on the filing of Form D or some other kind of penalty. The subcommittee suggested, for example, that violators lose the ability to rely on Reg D exemptions for a 12-month period. Moving on to guardrail number 4. For guardrail number 4, the subcommittees recommend that the SEC mandate information parity among investors in the filing of a Form D amendment at closing. It should also consider expanding Form D through notice and comment rulemaking. For this guardrail, I will start by borrowing a phrase from Commissioner Purse's speech yesterday and say that it is the subcommittee's recommendation that if and when retail access is expanded, it will finally be time for the SEC to fix the form. And by the form, we mean Form D. While the precise contours of the information requirements should be determined through notice and comment rulemaking, the subcommittees support the notion of scaled disclosure, where information requirements are calibrated based on the size of the securities issuance or the size of the issuer. There are some basic bits of information that seem fairly straightforward and common sense additions for Form D. Those information fields include issuer's legal counsel, the accountants or auditors, description of the general solicitation plans, description of the business including products or services offered, listing of officers or directors with greater than a 5% equity stake, expansion of item 16 use of proceeds, disclosure of any findings of securities fraud and enforcement actions, and importantly, disclosure of material risk and conflicts of interest. That list is intended as a starting point to give investors in the SEC a complete picture of the offering. However, including the amount of capital that is actually raised, the subcommittees also recommend that issuers file a closing amendment to Form D, as previously proposed by the SEC in 2013. When it comes to disclosure, the subcommittees believe that what is good for the goose is good for the gander, and thus also recommended that issuers be required to provide copies of any information provided to one investor to all other investors. The subcommittees recognize that there may be special circumstances where that may be unworkable, and in those scenarios, we understand the SEC may consider appropriate exceptions or waivers. Lastly, the subcommittees closed out their recommendation with a special Reg D disclosure consideration for large private firms. Should the SEC proceed with expanding direct access, these subcommittees recommend that the SEC study whether to require ongoing reporting by large private issuers. If a study is undertaken and its findings warrant, the SEC might find it appropriate to create a new category of large private issuer that would provide ongoing Form D type of disclosure once the company reaches a valuation of at least $700 million and have more than 1,000 beneficial equity owners or are affiliates of a registered broker-dealer. That concludes my presentation of Part 3. To keep the session moving along, I would like to give some of the major drafting or contributors to the draft an opportunity to see if I missed any points or if they would like to share any additional comments. So I will first turn to George, then go to Andrew and Gina Gale to see if they have any points that they would like to reinforce. And then I'm also going to share some remarks wearing my NASA hat before we open it up to the entire floor. But George, I will hand it over to you.
Thank you, Andrea and Paul. I am happy to support this recommendation, but I want to take a couple of minutes to talk about the problems that it addresses and the solution it proposes. So in an ideal world, this is not the place where we would be. In an ideal world, investors would have access to public market opportunities because public markets remain the gold standard in terms of price discovery, in terms of liquidity, in terms of real-time monitoring. But this is not where we are. We live in a world where private markets have expanded considerably, and many of the most exciting investment opportunities reside in private markets. So it appears unfair to exclude to exclude retail investors from accessing those markets. So the problem is the inability of retail investors to access exciting and investment opportunities and to diversify and to benefit from that. The solution we propose isn't to say that private markets are better than public markets, but it is to say that recognizing the reality, and if we want to give retail investors access to those private markets, the better way to do it would be through registered funds, because that framework, indirect access, contains already significant protections, and then there's also scope within it to provide additional protections. And most notably, in most cases, indirect access also means that investment in private market assets would be through a diversified vehicle. I also want to highlight the problem that we are not solving. So the problem that we are not solving, and in fact we're making worse, is the decline of public companies. The decline of public companies is a topic of frequent conversation, and we know for a fact that the decline in the number of public companies is due to changes in institutional investor preferences and significant M&A activities. In fact, the decline of the number of public companies did not start during the noughts after Sarbanes-Oxley, but it actually started in the mid-1990s. So it predates Sarbanes-Oxley. And so it's not a function of overregulation, but it's a function of changes in institutional investor preferences, decrease in investment analyst coverage, and so forth. And we are making this problem worse, and that problem is only going to get worse because we are increasing the availability of private capital for companies to stay private, and therefore they have less of an incentive to tap the public market. So we're not going to help that problem, and we are only going to make it worse. But given the world as it exists today, and given the fact that retail investors need opportunities for diversification, they need access to those investment opportunities, I'm happy to support the recommendation to endorse indirect access over direct access.
Thank you, Andrea. One of the other considerations over the course of this recommendation was, some of the issues that we were not able to resolve was just in terms of direct access, how do you actually solve the questions around adverse selection? Because one of the issues is, are we led to believe, what leads us to believe that retail investors can get the same investment opportunities as some of the largest institutional investors, if we're thinking about, our university endowments and large pensions, for example. This is not an issue of sophistication nor disclosure, and so. But we're also acknowledging the fact that there are a certain set of retirees at the same time, for example, with defined contribution plans or other types of public plans that do have access to private markets, a small percentage. So, we recognize these issues here, and so that these are all some of the challenges that we see with direct access to, to private markets. And so for that reason, and for some of the other reasons we've heard in past panels, we've heard of, in cases of direct access, issues around affinity fraud and other types of fraud. And so with a registered fund, you at least minimize that risk a little bit more because you are dealing with professional investors who have teams in place to be able to do a deeper due diligence. So for that reason and others, as Paul mentioned, there are still a number of issues that need to be considered around, as he mentioned, around valuations and proper disclosure of the illiquidity and the basic terms of the fund. But with all these things considered, I will also be supporting the recommendation.
Thank you, Andrea. Thank you, Paul. So first, I want to start by thanking you guys for bringing this to the finish line. It's been quite the journey to bring this recommendation to fruition and to bring it to the committee. And I really appreciate Andrea's statements on the fact that this recommendation is trying as best as it can to be Switzerland in its approach to this question of retail access to direct markets. And so my comments are going to focus almost exclusively on that accredited investor section of our recommendation. And my comments will be very brief. And really there are two caveats and three comments that I want to make here. So the first caveat or the first comment I want to make here is just to state the obvious, right, which is that our private market exemption is now swallowing the rule. Right? And it's swallowing the rule, I believe, to the detriment of us all. The growth and the size of the private markets should signal to us that something is amiss in terms of the balance in the securities markets. With the exception, when the exception becomes larger than the rule, I think it's unsurprising, therefore, that the average investor thinks that they are missing out or being excluded from something that is better. When just as George said earlier, the public markets are the gold standard, right? And that's where we should be trying to push as much of our investments as possible. And the second caveat or comment I will make here is that I recognize that the train has left the station, so to speak. And so what I recognize here is that we are trying to provide some input given the current state, given where we are, given that there are a host of bills before Congress. There is litigation claiming that the accredited investor definition is discriminatory. There is a clamor and a demand for access to the private markets. But I will just continue to play a role of trying to be a canary in a coal mine and say that I personally believe that we are headed in the wrong direction on this issue. We shouldn't be thinking of ways to expand private market access in which retail investors will face adverse selection problems and investments that are opaque, illiquid, complex, and lack just the basic information that they need in order to efficiently deploy their capital. Instead, we should be thinking about how to either make these private markets closer to the public markets rather than just opening them up. And so that will serve as the basis for my three comments, which I promise will be quick. The first comment here is one on recalibration. We've noted, and I've noted, everyone's noted, the private markets have grown, and they're grown to be larger than the public markets. This recalibration that we consider shouldn't be to open up the private markets, but we should be considering instead how to strengthen the public markets. The current private markets are well past the small number of investors that Ralston Purina envisioned way back when. I'm a securities law professor, so I think a lot about Ralston Purina. And now instead we have a private market that is larger than the public market. And this recalibration that we seek is to make private markets even more accessible with very few, if any, of the necessary safeguards. And I recognize that in our recommendation we put forward safeguards, but a lot of the discussion is without safeguards. And these safeguards, I believe, are necessary in order to make the private markets or private market investments fair and efficient for investors. And as we think about this as the current trend of recalibration towards opening up or having greater access to the private market continues, we're only going to continue to undermine and weaken the public markets, as George mentioned earlier, which I believe is going to be to the detriment of us all and dragging us back to pre-1933 days. Personally, I don't want to go back there. It didn't seem great. Despite what others might think. The second comment I have here is on information. Again, Ralston Purina expected that there would be some disclosure even to the small number of investors, even for a private market transaction. And so the private markets that we have today, they are opaque. There is little to no disclosure of information to investors unless the investor has enough market power to bargain for this information separately. The lack of disclosures makes it difficult for investors to assess their investments or to assess the possibility of these investments. And in this way, I'm going right back to something I've been saying throughout, the private markets continue to undermine the fundamental bargain of the securities laws, which is continuous disclosure of material information to investors in exchange for the ability to raise capital publicly or from the public. In the 1930s, in the wake of the Great Depression, Congress saw the importance of disclosure to help investors efficiently allocate capital and to level the playing field, and we can talk about whether or not it's actually level, but level the playing field between the average investor and insiders. And as we expand access to private markets, we have to think about providing this basic information and disclosure to investors, and I think the proposals to amending Form D that Andrea discussed are just the beginning there and have to be a part of this discussion. Third and finally, this is something that is actually not a part of the recommendation, but something I would like to raise. We have to think about what the recourse will be in the private markets. Yes, Section 10B and Rule 10b-5 apply to private market transactions just as they do to public market transactions. But what the research will show you is that private market litigation is almost non-existent when it comes to questions of fraud and manipulation. And that's because we have no information, we have no disclosure. And so as we open up these markets to retail investors, what is the recourse for our retail investors as they are harmed or if they are harmed in these markets? How will they get to, how will they have recourse, the recourse that we are so accustomed to in the public markets in which our investors can bring suit for fraud, for manipulation? And so these are the issues that I would like to just raise. I will be supporting the recommendation, though I am overall concerned about the trend line on this matter. Thank you.
Thank you, Gina Gale. I also have some remarks. The subcommittees are Switzerland, but as NASA's representative, my organization is not, and so I will read some remarks on NASA's behalf. I will be voting in favor of the recommendation on NASA's behalf. NASA believes that the recommended investor protection guardrails are a good start for improving the private and exempt offering marketplace, but remains generally opposed to diluting protections in the accredited investor definition. That definition exists to protect investors who are in no position to fend for themselves. The SEC must do more to improve Form D, market transparency, and its own oversight before it can responsibly move on to expanding retail access. Opacity, questionable valuations, and illiquidity are hallmarks of private market assets, which make them risky for retail investors. If Congress or the SEC chooses to expand retail investor access notwithstanding those risks, it is imperative that the SEC use its regulatory authority to mitigate the potential for investor hardship and loss. Investor protection remains part of the SEC's mission, and expanding retail access to private markets without the types of guardrails outlined in this recommendation would be inconsistent with that mission in NASA's view. I'd like to share NASA's feedback on a few other hit list items in today's recommendation. I'll tick through them quickly. First, with respect to registered fund reforms that would expand retail access indirectly, NASA supports the recommendation for enhanced transparency on valuation and liquidity of private market assets because retail confusion and misunderstanding on both fronts are fairly common. NASA is less enthusiastic about the IAC's approval of the SEC's recent relaxation of the 15% liquidity cap in registered funds. If fund advisors and directors do not land on optimal percentages, it will be retail investors who suffer the consequences. With respect to the accredited investor definition and the other reforms that would give retail investors greater direct access, NASA believes retail access should be expanded only if complementary improvements are made to private securities disclosures. As NASA has pointed out over the decades, disclosure regulation does not work without effective disclosure, and regrettably, Form D is currently crafted does not provide it. NASA is pleased to see Form D enhancements and enforcement of filing requirements included as key investor protection guardrails urged in this recommendation. NASA would add to that list deletion of the decline to disclose box entirely and advance Form D for all Reg D offerings and other enhancements outlined in the IAC remarks offered by my colleague in Alabama, Amanda Sen, in 2023. NASA is aware of and concerned about legislative efforts that would prohibit the SEC from enhancing disclosure requirements under Regulation D along the lines recommended today. NASA stands ready to discuss with policymakers why Form D reform is not a problem to avoid, but a helpful and necessary step to advancing any private market access proposal. As for the special accredited consideration, NASA would have preferred a recommendation that retirement assets be excluded from the calculation used in the net worth test. Many older investors need liquidity to cover health care and other expenses. Many simply are not in a position to recoup the loss of their lifetime savings. Excluding retirement assets from the calculation would ensure investors have a cushion outside of their retirement savings to cover any losses they might absorb in speculative private market investing. On a positive note, NASA was pleased to see the subcommittee reject a definitional approach that would qualify retail investors as accredited simply by receiving advice from a licensed intermediary. The conflicts are simply too great to make this a safe pathway for retail investors. The subcommittees are right to steer the SEC toward qualification paths that assess the retail investor's own sophistication. NASA is open to the SEC accepting additional credential pathways, particularly those that states accept as a substitute for a licensing exam, but would need to hear more about the contours of those pathways before endorsing them. As for an accredited investor test, NASA would prefer an exam that tests relevant knowledge coupled with practical experience, and NASA would not endorse a test that does not meaningfully probe the investor's financial sophistication and ability to understand the information asymmetry and other risks posed by private market investing. For example, NASA has communicated to Congress that it opposes the use of the Securities Industry Essentials, or SIE exam, as the means for qualifying retail investors. NASA agrees with the subcommittee that any test should be developed by the SEC in consultation with FINRA and state securities regulators. Finally, NASA appreciates the sentiment reflected in the recommendation's closing statement that the SEC should consider how the policy choices it makes here in the private market are reconciled with its investor protection policies for other unregulated or exempt assets that are also opaque and risky. Whether it's a Reg D deal or an offering that relies on a new regulation established for digital asset offerings, retail investors need effective disclosure to understand what they're getting into. They need regulators who are paying attention to these offerings in order to screen out fraudulent deals and bad actors. That is what securities regulation is all about. Adopting the investor protection guardrails noted in the IAC's recommendation today could help the SEC not only keep investors out of harm's way in the private market, but protect investors participating in other unregulated or exempt markets too. Thank you.
Thank you, Paul, Andrea, George, Andrew, Gina Gale, for your remarks and your summaries. Are there any further questions or comments from members of the IC? Jennifer?
Thank you. And I appreciate all of the hard work that everyone has put into this recommendation. I think the comments this afternoon have shown just how difficult it is to reach consensus. And unfortunately, I am in a position of not being able to join the consensus on this topic and will be unable to support the recommendation. I like the characterization of Switzerland, but it's not my view that this recommendation is actually taking a Swiss position. By stating that the committee's view that the optimal way for retail investors to access private markets is through registered funds, and not taking a position on the desirability of expanding retail investors' direct access, this recommendation supports the status quo on direct access, and I cannot support such a view. While I'm supportive of providing more access to private market assets for retail investors through registered funds, it is not the role of the SEC to determine the optimal way for investors to access such investments, particularly to the exclusion of other options for access. Investors should be able to choose whether registered funds meets their needs, which in many cases they may very well, but they should be free to make that choice in a world where direct access is available. Unfortunately, the committee does not recommend that the SEC explore the availability of more direct access, instead defaulting to give policy recommendations if and only if the SEC chooses to take the path itself or is otherwise forced to by Congress. But the limitations on direct access to private market assets by retail investors should be revisited and relaxed, and I am unable to support a recommendation that does not take such a stance. As we've noted, there's widespread agreement that the line drawn by the accredited investor definition is really not defensible. The committee recognizes today's reality that private markets have grown in recent years, and retail investors no longer have easy, if any, access to large swaths of investment opportunities. The committee also recognizes that the accredited investor definition is both over-inclusive and under-inclusive, a conclusion that makes sense given the poor proxy that wealth plays for financial sophistication and risk tolerance. The type of paternalism embodied in the accredited investor definition, the SEC making the decisions about which types of risks individual investors should be permitted to take, is problematic in and of itself. But the concern here is not only a philosophical one. By excluding a large group of Americans from a growing portion of offerings in the market, the current regulatory regime limits the abilities of such individuals to amass wealth, diversify holdings, and hedge certain risks. It also impacts the ability of would-be entrepreneurs in less wealthy communities to turn to those that they know best when building their businesses. These issues deserve rectification, not a guidebook to action if and only if the SEC is forced to act. I'm largely supportive of many of the recommendations made with respect to retail access through registered funds, but I cannot support such recommendations based on the conclusion that registered fund access is the optimal, and under this committee's recommendation, the only practical way for the majority of Americans to access private market investments. The proposed guardrails with respect to direct access also raise a host of suggestions for an expansion of access, including a focus on sophistication rather than wealth, and granting basic access to all investors that may be promising paths to pursue. I disagree, however, that such expansion of access must necessarily be accompanied by additional standardized disclosure, and I disagree that the SEC should consider periodic reporting for large private companies. These ideas call into question the Commission's authority to fundamentally redraw the lines between public and private companies. But fundamentally, despite some of my points of agreement with portions of the committee's recommendation, I cannot vote in favor of a recommendation that concludes that retail investor access to private market and assets should only be expanded when that exposure comes through registered funds. Thank you.
Thank you, Jennifer.
Christine Lazaro is online.
Oh,
She would like
okay.
to swear in.
Christine?
Thank you. So I have a couple of comments to make on the recommendation. I would like to start by thanking all of the committee members, past and present, who worked on this recommendation, and especially Andrea, Paul, George, Andrew, and Gina Gale. I'm supporting today's recommendation. With respect to the recommendation set forth in Part 2 related to the intermediated access to the private markets through registered funds, I agree that registered funds are a more appropriate mechanism for retail investors to access the private markets, as opposed to direct access, and the accompanying recommendations facilitate that participation. I also support the recommendations, including Part 3 related to direct access. However, I do feel it's important to comment on the arguments that lead us to discuss expanded access in the first place. I appreciate Gina Gale's comments and concerns, and will be echoing some of them in my own comments. There is no question that the private markets have expanded over time and that fewer companies are choosing to go public. But the argument that all retail investors should have basic access to the private markets due to its growing prevalence ignores the foundational premise of the federal securities laws. As a securities professor, I also come back to the history of the laws to inform this discussion. When President Roosevelt signed the Securities Act of 1933 into law, he said, quote, "Events have made it abundantly clear that the merchandising of securities is really traffic in the economic and social welfare of our people. Such traffic demands the utmost good faith and fair dealing on the part of those engaged in it. If a country is to flourish, capital must be invested in enterprise. But those who seek to draw upon other people's money must be wholly candid regarding the facts on which the investor judgment is asked," close quotes. As noted in the recommendation, the registration requirement within the Securities Act serves as a mechanism for ensuring investors in the market receive full and fair disclosure of material information. Section 4A2 of the Act provides that the registration requirement shall not apply to transactions by an issuer not involving any public offering. In other words, transactions involving public offerings must be registered. In 1935, shortly after the Act was adopted, the Commission set out guidance regarding the factors to consider when determining whether an offer would be considered public. The 4 factors include the number of offerees, the number of units offered, the size of the offering, and the manner of the offering. The Commission expressed that it was concerned about large issuers accessing investors through this exemption. The guidance made it clear that, in general, private offerings should be small. They should reach no more than 25 investors. They shouldn't be raising a significant amount of money or offering a large number of shares. In 1953, the Supreme Court weighed in on this interpretation when it decided SEC v. Ralston-Purina, and in that decision, the court focused on whether the particular class of persons affected needs the protection of the Act. An offering to those who are shown to be able to fend for themselves is a transaction not involving a public offering. With this decision, sophistication of offerees became a factor in determining whether an offering was public or private. Reg D was an attempt to draw a bright line in defining that sophistication by setting forth income and net worth tests. Although these tests were at best a flawed proxy for sophistication when they were adopted, and failed to address the ability of an investor to access relevant information, today they fall far short, as the standards have never been indexed for inflation. While they captured the top 2% of households when adopted, today they sweep in a much broader slice of the population, often as a result of retirement savings. There are many concerns for retail investors when directly investing in the private markets, whether they qualify under the overly broad accredited investor definition or not. The recommendation highlights those concerns, which were discussed at the committee's March 2023 meeting. Lack of available information asymmetry, the inability to perform adequate due diligence, and the inability to negotiate favorable terms. These concerns underscore why registration was required by securities laws in the first place, to create protections for investors in what was otherwise a marketplace of caveat emptor. As an investor advocate, my goal is to ensure investors can make informed decisions about how to allocate their capital. Through my work directly representing retail investors over the years, I've seen many instances where investors were harmed through direct investment in private placements. These investors did not knowingly choose to put their money at risk and certainly did not seek out access to these markets. They sought conservative to moderate risk investments with income, and private placements were sold to them as consistent with those objectives. They were given the impression that because they qualified as accredited investors, often due in large part to their retirement savings, they were getting access to superior investments. In truth, in case after case, the investments were far from superior, and the access to the private placements led to loss and retirement insecurity. Recognizing that there could be a middle ground, especially for smaller issuers, the recommendation includes suggestions regarding the expansion of categories of information required to be included within Form D. As a starting point, this helps to ensure investors have consistent, basic material information with which they can make informed investment decisions. When combined with prudential limits, this added disclosure can help address the concerns for retail investors participating in the private markets discussed earlier. Prudential limits also encourage risk reduction through diversification. However, prudential limits alone do not obviate the need for additional information in these markets. I appreciate the argument that investors should have choice, but an option without information is not a real choice. I urge the Commission not to replace investor protection with predatory inclusion in the name of access. When issuers choose to have broad access to investors, they are engaging in a public offering and have a responsibility to the marketplace to be candid about information material to an investment decision. In sum, as we seek to facilitate capital formation, we must be cognizant of the economic and social welfare of retail investors, as discussed by President Roosevelt at the signing of the Act. I believe today's recommendation balances these two considerations, which is why I'm able to support it. Thank you.
Thank you, Christine. Rodney.
As a new arrival to this group, at this meeting, I just wanted to say thank you first to all those on the IAC, and specifically Andrea and Paul for their work. In general, I will be supportive of the recommendations today. I think the approach has done a balanced and constructive approach that should help investors going forward. I would stress in the case of indirect investing, we do think that for closed-end funds that the N2 forms of disclosures could be improved and mirror more the N1 open-ended funds with much more plain talk in English as people choose to invest in things and need that transparency in the disclosure to make the best investment decisions. Finally, I would say, and it's been mentioned by a few others, I think we should continue to push that private markets are a place for the incubation and the creation of additional public markets, which are still some of the best places in the world to invest here in the United States for investors to achieve investment returns. Finding that balance, I think, is an important issue going forward. Thank you.
Thank you, Rodney. John, and then James.
Thanks, Brian. So I'm new here as well, and I do want to begin also by thanking everyone for their hard work. I saw this for the first time just a few days ago. It's really impressive. The first thing I thought is, oh, great, we have a staff. And then I realized we don't. So it's quite amazing, all the work and effort that went into this. I think it's a very, very thoughtful document. I think I'm supportive of it. I do have a question, or a couple of questions. So in reading through the registered funds recommendation, I read it as additional requirements that we support to apply to the registered fund. I don't see in it any additional requirements that would apply to private funds or to the private companies should a registered fund invest in that. So I guess my question was just a clarification. Is that correct?
That's correct.
Okay, great. And then my other question is, this would be my first vote as an IAC member. I assume it's up or down on the whole thing, right? It's not
Correct.
like I support part. Okay,
Correct.
Got it.
Yeah.
Okay, so I think I've already mentioned to a few of you before. I'm the executive director of the Committee on Capital Markets Regulation, which is a research and advocacy group with members from across the financial sector, academics, as well as former policymakers. We've weighed in on this issue in the past. And we also have said that the best way forward is through registered funds for expanding retail investor access. So I support that approach. With respect to direct access, my view is there is risks and need to proceed cautiously on how to do that. Whether or not this recommendation includes the exact approach that I envision, I'm not sure that's the case, but I understand the spirit underlying it. So with that, I'm supportive. Thank you.
Thank you, John. James?
Yes, I'm also a newbie here, so I do want to cabin my remarks with that and say that I really appreciate the exceptional amount of work that went into this effort, the balancing of interests among a sort of diverse members of this committee, and to acknowledge that I had no role in any of that process, which is why I'll be abstaining from this vote, because I don't think it's fair for me to fair to me to cast a vote for something I wasn't involved in the crafting of. And I do want to emphasize my general thought that this is an extremely important issue, and my generally enthusiastic support for expanding access to private capital, which isn't necessarily the unanimous view that's been expressed here today, but I think is at least somewhat implicit in the recommendation here today. I'll quote from the comment I submitted to the House Financial Services Committee in March as it was considering a battery of bills in this space, which as Professor Fletcher alluded to, a few of whom have passed the full House of Representatives at this point, particularly focused on the accredited investor rule that this proposed recommendation sort of overtly avoids. And what I said there was, in recent years, greater availability of private capital, SEC rulemaking under Regulation D, and the heightened costs of publicly traded ownership have combined to make private placements of capital increasingly important to capital formation. While the shift away from publicly traded ownership raises its own concerns, the solution is obviously not to impede private capital placements, which are an essential component of modern equity financing. That said, overly strict rules on investor accreditation threaten to create even more of a two-tiered capital system in which only wealthy individuals have access to broader and broader swaths of the American capital market. In addition to raising fundamental issues of fairness, limiting access to this vital component of modern capital markets risks undermining public confidence in the free enterprise system itself. I want to emphasize that I would advise caution in what particularly we're adding on in terms of regulatory burdens as a supposed necessary consequent of the salutary effort to open up private markets more broadly. The last thing we'd want to do is discourage private markets overall, which have been a key source of raising capital and an effective safety valve for what I generally characterize as regulatory overreach from the SEC we advise. And yes, that's implicitly disagreeing with Professor Georgia's empirical assertion that our broad regulatory climate for publicly traded companies is unrelated to the decline in public investment, a subject I have written about since around 2006 when I first testified before the House Financial Services Committee on this issue. I agree with the premise that private market access may be most broadly reached through funds and intermediaries. Although I would expect that retail investors investing through funds would be the dominant way of accessing private markets, I, like Commissioner Schultz, am not convinced that fund investing versus direct access is the quote-unquote optimal way or the quote-unquote better way in all cases. I said commissioner. It's really committee member, I guess. Sorry. I don't know. Put you on the committee. You'd be a good commissioner. I recognize that by necessity, this committee includes a number of representatives of institutional investors, as well it should, but this is the Investor Advisory Committee, not the Institutional Investor Advisory Committee. And I share Commissioner Peirce's concerns with fund valuation and life cycle analyses that may be an undue burden. I am somewhat uncertain about the scope of the proposed enhanced protections here, knowing that any such protections can be de facto prohibitions that may stifle the access we hope to encourage. And while the SEC should obviously be apprised of the views of FINRA and state regulators, it's not clear to me that we're striking exactly the right balance here. But my bigger concern is the express avoidance of any recommendation to change accredited investor rules, and the argument that any such changes, were they to be adopted by the Commission or by Congress, would come with heightened regulatory burdens, characterized as guardrails, that would be added as purportedly necessary adjuncts to expanding access to private markets. Some of these guardrails do make sense to me that are proposed here. I want to make clear. I agree that investor sophistication, is the right metric here as opposed to these sort of artificial net worth tests. Seems to be a longstanding IAC position. The question remains how we assess that. There are 3 different proposals that have passed the House of Representatives on this, others that have been floated. I want to emphasize, I'm coming at this from someone who's invested in private companies multiple times. And, when I was still a law student or shortly thereafter, I invested in startup ventures from 3 different classmates. Obviously, a number of, my fellow classmates weren't able to access these. And as one might expect with startup ventures, 2 of them were complete losses. One of them, on the other hand, has returned more than 3 orders of magnitude return. I question, because some of these investor sophistication tests that have been proposed, I wouldn't have been certified under various of these tests for investor sophistication. A number of my other classmates may not have either. I don't know if I would want to sit for some exam that FINRA came up with. So I question that. I do recognize that the inflation adjustment as proposed is sort of an either-or situation, but if it doesn't make sense to use net worth and income statements as a proxy for investor sophistication, I wonder why we're continuing this at all. I get that it's sort of a safe harbor. I think that the 10% of assets rule is broadly preferable to what we have now, I wonder what the due diligence requirements will be to oversee that. And I want to emphasize that not all private investments have comparable risk profiles. So if you're investing in a startup business, like I did 25 years ago plus, it's a different risk profile than, say, if I have a friend who's an investment banker and I want to do what's effectively bridge financing for an investment banking transaction, which has a very different risk profile. And I'm not sure that a 10% threshold is the right threshold there. So I think if we're going to do that, we need to be very careful in what we think about, in thinking about it and making sure that we're not squeezing out access to other sorts of investments that don't have the comparable risk file. I also agree with Commissioner Peirce that any beefing up of Reg D is not without risks, and I worry we'd be using increased access that we're supporting here as a stalking horse for greater regulatory burdens that overall hurt capital formation. I'm also quite skeptical of foisting new periodic disclosure requirements on large private issuers. So I have some concerns here. I wasn't involved in the process. I'm going to abstain, and I look forward to joining as we consider other such recommendations down the road. Thanks.
Thank you, James. Before I ask for a motion, any other questions or comments? Okay. I'd like to read a statement from Nancy Lamond. As you know, she's the statutory representative of the seniors, and she asked me to read this, so let me do that. As you're aware, America is facing a retirement crisis. Roughly one half of the country has little to nothing saved, and the other half is rightfully concerned that they will outlive their savings. In fact, AARP's latest financial trends survey shows that close to 2/3, 64%, of Americans are worried they won't have enough money for a secure retirement. With fewer and fewer workers having defined benefit pensions, we're entering an era where people are responsible for both funding their retirement and making that money last for what could be 20 or 30 years. It is paramount, therefore, that retirement funds are protected and invested solely in the best interest of savers. The private market is a risky business for retirement savers, and for that reason, AARP steadfastly opposes any dilution of the accredited investor definition that could place those savings in harm's way. The stakes could not be higher. We as a group have a responsibility to ensure those handling and giving advice about people's hard-earned retirement savings act only to preserve and grow those funds to the maximum extent possible. That said, I understand that policymakers may choose to expand retail access to the private markets through changes to the accredited investor definition or other methods. I appreciate the work of this committee to recognize that and provide meaningful mitigation measures in furtherance of our mission. Given the headwinds we're facing, we're clearly stating our concerns and offering these suggestions should our concerns go unheeded. To that end, I am voting yes, a cautious yes, with a degree of caution. Okay, with that, do we have a motion? Please note that if the recommendation is approved by the committee would be approving in its substantially final form as posted on our website, subject to any final non-substantive changes to the style and format and its footnotes. With that, all those in favor, aye?
Aye.
Aye.
Any abstentions?
Abstain.
Those opposed? Let me read it into the record again. For the record, I have proxies from Alvin Velasquez, Craig Knock, Nancy Lamond. Thank you. Motion is passed. Thank you very much. Well done. This is a lot of work. We have a couple minutes more of work here for the committee, a couple of brief reports from the subcommittees. Andrea, investor is owner.
We've been working on a recommendation for private market access to retail investors.
There you go.
So that really has been taking a lot of our time. Vice Chair Jennifer Schulp moderated a panel at the June meeting on pass-through proxy voting. continuing to look at that issue. And welcome our new members, Investor as Owners, a great subcommittee. We work on a lot of exciting issues. We all work together anyway, so hopefully you will, talk with me if you would be interested in joining us. That is all, Brian. Thank you.
Okay. Andrew, market structure?
Yes, so similarly, we have been spending a lot of time working on the private market recommendations, so thank you for everyone who has been involved in this process and all of your feedback and discussion. So looking ahead, the subcommittee is now thinking about potential panel on tokenization, given the fact that in recent months we have seen a number of funds and also some stocks that have been issued over the blockchain. And so there are many considerations here, both in terms of how does this interact with our securities laws, what are some areas that we can be looking at with the existing both trading, settlement, and other parts of the ecosystem that we could also be asking some questions on. So I look forward to working with fellow committee members on narrowing down the scope of the topic so that we can put together a panel on this shortly.
Okay. Christine Lazaro, are you on?
Yes.
Okay. On behalf of disclosure.
So the Disclosure Subcommittee continues to work on a recommendation related to the panel on artificial intelligence, which we hope to present at the next meeting. That's been our primary focus.
Thank you. That concludes our subcommittee report and formally ends today's meeting. I want to thank again George for your extensive work on both the panel and on the report, as well as the work done by Andrea, Paul, Andrew, Gina Gale, and a host of others in the year plus leading up to today's vote on our recommendation. And I also want to extend my gratitude to our investor advocate, Christina Martin-Fervita, along with the staff, Mark, Andrew, Adam, and Charles, and the entire supporting team of SEC staff whose efforts ensure that our IAC continue to operate seamlessly. Thank you very much, and this concludes our meeting.